You just received a big bonus. Or maybe you've been saving for years, building up that cash cushion for the day you finally decide to invest. Now you're ready to take the plunge. But the question hits you, do I invest it all at once or slowly over time? You're not alone if that question makes you feel uneasy. Holding on to cash feels safe. You can see it in your bank account. It's not going anywhere. But investing it? That's where things start to feel risky. What if the market crashes right after you invest? What if you mistime everything and regret your decision for years? That's where today's video comes in. We're going to break down the two most common ways to put your money to work: lump sum investing and dollar cost averaging, also known as DCA. Let's dive in. Section 1, understanding lump sum investing. Let's start with the straightforward one, lump sum investing. This means you take the entire amount you plan to invest, whether it's $10,000, $100,000, or your entire savings, and put it all into the market at once. No waiting, no gradual entry. You're all in right away. The pros are: 1, statistically superior in most cases. Research from Vanguard and other investment firms consistently shows that lump sum investing outperforms dollar cost averaging about 2/3 of the time. Why? Because markets tend to rise over time. Historically, global stock markets have gone up in about 3 out of every 4 years. That means the sooner your money is in, the longer it can compound. If you wait, you're essentially leaving part of your portfolio sitting idle, missing out on potential growth. 2, simplicity. Lump sum investing is incredibly simple. You make your investment once, set your allocations, and then let it ride. No need to schedule monthly transfers or second guess when to invest the next chunk. 3, full exposure to gains. When markets go up, every dollar you've invested benefits. There's no cash on the sidelines missing out on the upside. That's a powerful advantage in long-term bull markets. The cons are sure as: 1, emotionally difficult. Investing a large amount all at once can feel terrifying. You might hit buy, then check your portfolio the next day only to see it down 3%. Your stomach drops. You wonder if you just made a huge mistake. Even though markets do recover, those early losses can be emotionally brutal. And for many investors, that discomfort leads to regret or even panic selling. So yes, lump sum investing is statistically efficient, but emotionally it can feel like jumping off a cliff and hoping the parachute opens. Section 2, what is dollar cost averaging, DCA? Now let's look at the more measured approach. Dollar cost averaging, or DCA. Instead of investing everything at once, DCA means spreading your investment over time, maybe every week, month, or quarter. For example, if you have $12,000 to invest, you might invest $1,000 per month for a year. The pros are: 1, reduces emotional stress. DCA removes the pressure of finding the perfect entry point. You don't have to worry about whether the market is at a peak or a dip, because you're investing gradually across all conditions. You'll naturally buy more shares when prices are low and fewer when prices are high, smoothing out your average cost over time. 2, builds discipline. For people who tend to overthink or delay investing, DCA creates a built-in routine. It's methodical, predictable, and consistent. The exact kind of behavior that successful long-term investors rely on. The cons are: 1, historically underperforms lump sum. Because markets usually rise over time, delaying your investment, even in small increments, often means lower overall returns. Statistically, by the time you've fully invested, markets may have already moved higher. 2, higher transaction costs. If your brokerage charges fees per trade, which is less common now but still possible, investing in multiple smaller chunks can add up. Section 3, the myth of perfect timing. Here's the truth that many investors learn the hard way. There's no perfect time to invest. Trying to wait for the right moment, when markets feel stable or prices seem low, is like waiting for the perfect wave to surf. You might end up watching from the beach while others are already out catching returns. Even professional investors with access to advanced analytics and decades of experience fail to time the market consistently. They'll admit it's nearly impossible. The reality? Markets are unpredictable. Short-term drops are normal. Long-term growth is typical, so whether you choose lump sum or DCA, what matters more is being in the market, not trying to predict it. A famous saying sums it up perfectly: time in the market beats timing the market. Section 4. When does lump sum work best? So when is lump sum the smarter move? 1. In a strong bull market or steady uptrend. When markets are trending upward, like during periods of economic recovery or strong earnings growth, lump sum investing tends to shine. You're fully invested from the start and get maximum exposure to those gains. 2. When you're emotionally comfortable with risk. If you're the type who can handle short-term volatility without panic, lump sum investing rewards your discipline. You know downturns happen, and you trust the long-term growth of the market. 3. When market valuations are fair or low. If markets have recently corrected or valuations look reasonable compared to historical averages, investing all at once can lock in attractive entry points. Section 5. When is DCA better? On the other hand, there are times when DCA is the better choice, not because it earns more, but because it helps you stay invested. 1. When markets are volatile or uncertain. If the market is swinging wildly, think pandemic-era volatility or major geopolitical shocks, spreading your investment can reduce the risk of bad timing and smooth out returns. 2. When you're nervous or new to investing. If you know that seeing an immediate 10% drop would make you panic, DCA gives you a gentler entry point. It's easier to commit smaller amounts over time and build confidence as you go. 3. When you value consistency over speed. If you prefer structure and routine, DCA fits perfectly. You can set up automatic transfers and take emotion out of the process entirely. Section 6. The real answer: it depends on you. So after all this, which is better, lump sum or DCA? Here's the truth. Mathematically, lump sum wins more often, but psychologically, DCA wins for more people. If you're the type who checks your portfolio every day and loses sleep over small drops, DCA might be your best friend. Section 7. A balanced perspective. For many investors, the best approach might be a hybrid. For example, you could invest half your lump sum immediately and spread the other half over 6 months. That way you capture some immediate growth while easing your way in. Another option: invest lump sum into a diversified portfolio. Maybe not all in stocks, but with bonds or other assets that balance out the risk. Remember, investing isn't about one perfect move. It's about building a system that matches your goals, temperament, and timeline. Section 8. Final thoughts. So what would you do? Would you drop it all in on day one, confident that time and compounding are on your side? Or would you take it slow, investing piece by piece and sleeping easier at night? There's no wrong answer, only the one that helps you stick to your plan and keep growing your wealth over time. If you found this helpful, hit that like button, subscribe for more simple, data-backed investing content, and share your thoughts below. No hype, no noise, just real strategies for long-term growth. Thanks for watching, and remember, the best investment strategy is the one you can live with. See you in the next one.